Hello everyone. Good evening. This is our team presentation for the chapter 5, cash and liquid asset management. And this is Mingzhen. Let me get a start. And first of all, the liquid asset that can be converted into cash in the short term or already in the form of cash, including checking account, money market fund, and certificate of deposit. More specifically, it can be calculated as the balance of current asset after subtracting the unstable inventory, prepayment, and non-current asset. Liquid asset works as a reservoir with money moving in as wages and moving out as living expenses. So to prevent the reservoir from running out, we need to have certainly sufficient liquid asset. With sufficient liquid asset, you can pay your bills to cover normal living expenses and also unexpected expenses. So you do not need to dip into your long-term investment, which means you do not need to sell stocks or your long-term investment or real estate when you don't want to. And the cash has been defined in the government financial statistics, the GFS manual. In GFS, cash on hand refers to notes, coins, and deposits, which are held on demand by government institutional units with a bank or another financial institutions. Um, Cash management is necessary because there are mismatches between the timing of payment and the availability of cash. Cash management means you make a decision of how much you cash to keep in liquid asset and where to keep them by using various management alternatives. More importantly, you need to manage and control this cash in order to stay on your budget. Based on character of liquid asset within low risk, the cash management will bring less profit or expected return by saving and short-term investment. Effective cash management provide contribution of the operation of fiscal policy, monetary policy, and public debt management strategy. And now let me get some points from the modern cash management. The modern cash management has four objectives. At first, we need to establish a treasury saving account in order to make sure we have sufficient cash to pay for expenditures. And moreover, we are supposed to borrow only what we need, and the government borrowing costs also need to be minimized. It's critical to maximize returns on idle cash by avoiding accumulation of low-yielding government deposits in the bank. We also need to focus more on the risk of investment. Investing temporary surpluses productively is a good way to manage and control risks. Furthermore, there are also some fundamental features for modern cash management. First of all, through treasury saving account, government payment function can be centralized because all of disbursement made directly from main operational account of the treasury saving account at the central bank. The coverage of the cash management framework is clearly defined. In order to make short-term projections, the cash managers need to have adequate historic data for projecting all inflows and outflows from the treasury saving account, such as the saving remittances, payment for expenditures, debt transactions. Effective cash management can only take place if there are skills and capacity to record, monitor, and project short-term inflows and outflows into treasury saving account. Moreover, the realistic budget projection are helpful for avoiding cash management problems. Such practices have a favorable impact on cash management, especially in countries that have limited or no access to short-term financial markets. There are several payment methods under the modern cash management. For enterprises, many corporate are moving their payment to centralized payment factories, which provide a centralized platform for straight-through processing of payment and streamlines the entire payment process. For individuals, many people like to use some app such as Venmo to pay for transactions. In China, most of people use WeChat Pay or Alipay to pay for every aspect in their daily lives, including the transportation and online shoppings. And nowadays, the stage of code is that more and more people do not have strict awareness of saving account and always blow their budget unconsciously. So another type of risk associated with keeping liquid asset is that the more cash you have and the more you want to spend. Imposing automatic savings is easier to stick to a personal budget since it is harder to overspend and dip into your saving once they are automatically removed from your bank account. So withdrawing money from paycheck before you get a chance to think about spending is really a good way to help you save money in the saving account. There are several automatic saving plans. For example, you can establish a saving account and link it to your checking account. From there, it's easy to request direct deposits through employer. You can have part of your paycheck directly deposited into your saving account, each circle with the rest going to checking account. Moreover, some apps can help you make and manage your automatic saving plan, such as Capital and Digit. Um, this app use mobile technology to make saving for goals not only automatic, but also relatively painless. For example, you can set up your saving plan in Capital and let the app save a certain amount of cash every time you buy a cup of coffee, for example. And that kind of rule can both help you save and because it essentially double the price of a cup of coffee. So it did help you cut down on those daily expenditures, which you probably don't need. The Digit is also a very useful automatic saving tool. It will analyze your saving and spending habits and then withdraw small amounts from your checking account into Digit saving account whenever it thinks you can afford it. Will these amounts are small enough that you might not even notice them? They add up over time to significant savings, whether you are focused on paying down debt, saving up for big expenses, or saving up for an emergency fund. It's super easy to use. You don't have to worry about meeting your savings goals, transferring money, or budgeting your spending. Instead, the digit happens in the background without you having to pay it any attention.
All right, well, there are two types of financial institutions. There is the deposit type and the non-deposit type financial institution. In deposit type institutions, these are typically banks that provide the traditional services such as checking and savings accounts. And then in non-deposit type institutions, some examples include mutual funds, stock brokerage firms, insurance companies, and so on. And these institutions appear to be similar to the deposit type based on the services they offer as non-deposit type institutions are beginning to offer more traditional banking services. All right, a few examples of the deposit type institution are commercial banks, savings and loan associations, saving banks, and credit unions. In commercial banks, they offer very basic services like checking and savings accounts, credit cards, lending and consulting services. One of their strategies is to provide convenient neighborhood locations in order to help build personal relations amongst the clients and the bank associates. In savings and loan associations, They provide similar services to commercial banks, but these institutions also typically earn 0.25% more interest in savings accounts at competing commercial banks. And they also are very similar in terms of products and services as typical saving banks. And then lastly, credit unions are established by organizations like churches, universities, and trade unions. They provide similar services to the savings and loan associations and commercial banks, but their membership is restricted to the members of the specific organization. And also because they're considered a not-for-profit organization, credit unions are tax exempt, which gives them extra benefits in terms of having typically higher interest rates and lower fees. A couple of the examples of the non-deposit type financial institution include mutual funds and stock brokerage firms. In mutual funds, professional investment managers are in charge of large pools of money collected from multiple investors to then go ahead and invest in stocks and or bonds. These investors can then earn dividends on stocks or interest on the bonds. And then in stock brokerage firms, these typically deal with stock investments and have been recently introduced to many different cash management services, which makes them now direct competitors with a few of the deposit type banks. Online banking is a way of conducting transactions and managing accounts through any device connected to the internet. It gives the clients a lot of flexibility in terms of when they wish to access this information anytime throughout the day. Some of the services provided are access to accounts throughout any point of the day to check balances, to see when checks have cleared, when deposits are made, to transfer funds between any two accounts, pay and receive payments online, and then also download financial information into either a personal finance or tax software. Clients also have the ability to choose if they wish to use an internet-only bank. Internet-only banks have no physical branch locations, but this gives the banks the ability to save costs on retail spaces, which can benefit them by providing higher interest rates and lower fees. Some of the advantages of online banking include personal financial management support. This is where clients have the ability to import their data into a personal finance program such as Quicken or TurboTax. There's also a convenience factor where clients can view and track accounts, pay bills, track credit card activity from a device anytime. And they also can receive real-time updates such on things like stock quotes. And then clients can also access and manage accounts like savings accounts, retirement accounts, CDs and securities from a secure site, and then make any transactions as necessary. Some of the disadvantages include the adaptation to the new platform. So some sites are difficult to navigate at first. It might take users a little bit longer to get used to. There's the occasional update too, that sometimes when apps are updated, there are new features added or the layout can change, which can disrupt the user experience. And then setting up an account and connecting it to your account through an online banking system can also take some time. Because online banking is no longer in person, it lacks the face-to-face service experience. So sometimes getting in touch with someone to help you online takes much longer than if you were to go into the bank yourself. And then lastly, many people dislike the idea of banking online and have trouble trusting technology with all their personal and private account information. So when you're looking to find a financial institution that best fits you, these three questions are really important to ask because you want to look at, which institution would have the services you need. Is the institution safe and secure? So meaning, will it protect you in any unprecedented event? And then are there any additional costs? So are there minimums for the balances? Are there holding fees? Things like that. It's best to look for one where you can easily access the service and management when you need it necessary. And lastly, financial institutions all vary in strengths. Sometimes the best strategies are from different institutions. So the best strategy is to get the best services from the best prices, and that might be at multiple institutions at once.
Okay, so I'll be talking about cash management alternatives. So first off, we have your typical checkings accounts, and this is where you deposit your liquid funds. And these accounts are typically convenient for paying your bills. There are two types of checking accounts. We have interest bearing and non-interest bearing. Interest bearing is a negotiable or known as negotiable order of withdrawal account that earns interest on your balance. And earning interest is a good thing, but you must maintain a minimum balance on this account. And if your balance drops, you will be charged with a penalty fee. The second type is a non-interest bearing that is actually a demand deposit. So the customer pays for the checking privilege by maintaining a minimum balance or being charged per check. There are two types. There's an advantage and a disadvantage. So the advantage is that you have your liquid funds and it's federally insured. However, there is a minimum balance that's required to keep the account open. However, these can be waived by either opening a college savings account if it applies to you, or maintaining a minimum balance on your account. With that being said, there are banks that offer no fees, such as Chime, Capital One 360, Ally Bank, just to name a few. These are known as, previously stated, the internet-only banks, but they have become more accessible. So if you go to a local gas station or a bank or even a CVS, they will have ATMs that are free of charge. Next is a savings account. This allows you to keep your money in a safe, federally insured institution while it earns a guaranteed fixed interest. So depending on the bank, typically savings accounts at your typical banks like Chase, Wells Fargo's, Bank of America, they do have a very low interest rate that can range from 0.01 to 0.05. However, high yield savings accounts can be opened with a Marcus Goldman Sachs account or Ally, Vio, and Chime, and these typically offer higher interest rates. In 2019, the interest rates were 2 to 2.5%. However, due to the pandemic, the Federal Reserve has cut interest rates to nearly zero, which has caused a lot of these banks to lower their interest rates. And right now, they're typically around 1 or less than 1%. Most institutions don't require a minimum fee. However, they can range from $1 to up to $1,000. Next is your certificate deposit or your CDs. These are saving alternatives that pay a fixed rate of interest while keeping your funds on deposit for a set period of time. So this time can range from 30 days to several years. An advantage is that they're safe, they're federally insured, and you get a fixed rate. The longer the period, the higher interest is paid on the CD. Disadvantages is that if you do withdraw before the period that you were initially opened the account with, you will receive early withdrawal penalty. And the fixed interest rate can vary. So let's say you open an account right now and the interest rate is 2%, but that interest rate drops like in a month or so, you're fine with the interest rate. But if you open an account with 1% interest rate right now and it rises in a month, you're still stuck with that 1%. So it can be a good and a bad thing. Most popular banks offer lower interest rates. So most people are switching to the online internet-only banks like Ally Bank, Discover, or CIT. These banks don't typically offer a minimum balance, but usually it can range from 0 to 2,000. Next is your money market deposit account or MMDA. These are alternative to the savings accounts offered by many commercial banks. They are safe, federally insured, and earn interest. However, you receive an interest that varies with the current market, so it's not a guaranteed fixed rate. But although the rates fluctuate on a weekly basis, it's generally higher than the fixed rate paid over on a savings account. Disadvantages are that there is a higher minimum balance, typically $1,000 to start. And if your balance drops, you get penalized. The MMDAs typically pay less than your other investment alternatives like a CD or mutual fund. Then we have the money market mutual funds, your MMF. So this is alternative savings accounts offered by financial institutions. So investors receive an interest on a pool of investments minus an admin fee that's typically less than 1%. The advantages is that you do receive a higher interest rate, you have check writing privileges, and there's limited risk due to the short maturity of investments. So by pooling investments, your investors can purchase a higher price investment, and that'll lead to a higher return than they would if they would do it individually. However, their interest rates on these accounts do vary daily as interest rates change, and there is a minimum initial investment that can range from 500 to 2,000. Okay, next we have the asset management accounts. These are comprehensive financial services, service packages offered by your brokerage and recently your investment banks. So that can be Fidelity, Charles Schwab, Goldman Sachs, Merrill Lynch. These include banking services such as checking accounts, credit cards, debit cards, MMF, loans, and just to name a few. Advantages is that you do receive monthly statements, automatic coordination of money management, unlimited check writing, higher returns, and it's very convenient. Disadvantages are it can be costly. Fees can range between 50 to 125 monthly, quarterly, or annually. So it just depends on the institution. And these accounts typically require a large balance that can range up to $10,000. And they're not federally insured. Next, we have your U.S. Treasury bills or T-bills, and these are short-term notes of debt issued by the federal government with maturities that range from 4 weeks to 12 months. Advantages is that they are risk-free, so it's guaranteed by the federal government. They are exempt from state and local taxes, and the federal taxes can vary with current rates. The minimum denomination is $1,000, and when you purchase a T-bill, you don't receive an interest payment. So instead, your interest comes in the form of appreciation. Disadvantages is that you do receive a low rate of return because they're exceptionally safe. So typically your CDs or your money market mutual funds will give you a higher rate of return than your T-bills. And then the last one is the U.S. savings bonds, which are safe, low-risk saving products issued by the U.S. Treasury Department. So when you buy them, you're making a loan to the federal government. And these are typically a very safe place to put your money. Some of the advantages is that they are safe, like I mentioned, return guaranteed by the federal government. They're affordable and they're available in low denominations. There's no state or local taxes, and they're exempt from federal taxes if you're using them for education purposes. They're also very convenient where you can buy through payroll deduction plans online or your financial institutions. You can redeem them at any bank, and there is no commission or sales fees. However, there are disadvantages, and they're low liquidity, so you must hold for 12 months, and you're penalized before 5 years. The interest compounds only semi-annually, and there's a limit on how much you can buy per year.
So when assessing all of the cash management alternatives that Kiara just went through, there are 3 things that you want to be looking for. You want to look at the returns with interest rates and same compounding periods. You want to look at the tax status, and you want to see if these alternatives pose any risk or are safe enough for what you're looking for. So when you're comparing interest rates, it's important that they all share the same compounding period. Many different financial institutions will quote their rates using different compounding periods. But through the Truth in Savings Act of '93, all financial institutions are required to list their APYs or annual percentage yields. This makes it much easier for investors and potential new clients to look at these rates directly and compare them side by side. Taxes can also affect the real rate of return on investments. For example, for some investments, part can be tax exempt and part of the investment can be taxable. The higher the marginal tax bracket, the more benefit you'll receive from a tax exempt investment. based on the formula below in this example with a 25% tax bracket and no state income taxes. Fund A is clearly the better choice for this scenario because it yields a higher return. And then some of the cash management alternatives are insured either under the FDIC, and then others are insured under the NCUA. Under either one of these federal insurances, depositors are insured for up to $250,000 within a financial institution. What this means is, say they have multiple accounts in one institution, they'll be insured for up to $250,000 across all of the accounts in that specific institution. Money market mutual funds, or MMMFs, are not federally insured, but because they are large and use high quality diversified portfolios, it reduces significant risk on its own.
Okay, as mentioned before, there are many options for cash management, but checking accounts are still vital for the function of the economy. Checks are used to pay bills, pay rents, and many more things. Just in 2015, as mentioned in the book, around 60 billion checks were written, but today, since there are like more electronic transfers, the number went down to 60 billion. Now I'm gonna talk about the how and why to open a checking account. The first step is to choose a financial institution. You have always to consider the three C's: cost, convenience, and consideration. Of course, we can never forget about the security that the financial entity can give us. Remember that you are forming a financial relationship with them. So that's why they spend a lot of money in customer care and service. Cost is the basic determination factor for most customers. We have to verify the fees, rates, minimum balances, and per check charge. In some cases, there are free checking accounts or other that offer you the free checking account, but with a minimum balance. Fees can be fixed, which is a good thing for most of the times. With minimum balances, your fees depends on it. Most of these institutions charge for checks, so you have to be careful about those fees. Convenience relates to the service that is easy to use. You want to have a location near you, or at least in your favorite destination for vacation. Some institutions offer free safety deposit boxes, and other for around $50 a year, which is still cheap. Overdraft protections refers to the loan made by the bank at a rate in case you run out of the money. Most of the times, these rates are expensive. How to reduce the overdraft fees in case you ever run into the situations. First, I have to say that this is a very common thing, and according to the book, in 2015, overdraft fees were around $11.6 billion, counting for 8% of banks' net income. In 2019 was 11 billions, so it's still high. In fact, banks do tricky moves. So let's suppose that you have $800 in your checking account, and you write one check for 800 and 8 checks for 100 each. If the bank processes the 800 check first, all 8 checks of 100 will bounce, resulting in 8 overdraft fees. But if the 8 checks are processed first, you will incur in only one overdraft fees. To be safe, you can choose an overdraft protection plan. Your card will bounce if you don't have the money, or you can link your saving accounts, so in case you run into an overdraft, it will pull out the money from the other account. You can ask for a line of credit as well, so it's the same way with that. You can link it the same way with a saving account, and it's very important to track your balances. So for tracking your balances is very important, as we can see in the picture in the right side. This is like a example of how you can write a checkbook, so you can keep your numbers on always like balance and reconcile with your statement. So first, for this, you will have to write a checkbook, write every transaction that you do, and then at the end of the month, you can reconcile it with the monthly statement, so you keep off track and you never run into an overdraft fee. So if you're planning of buying something of a big amount and abroad, your regular check could not be accepted because there is no security that you have money in your account. So for that, there are other type of checks, like the cashier check. That is a check from a bank, meaning that it can be accepted everywhere, and you don't need to have a checking account to get one. Love of money refers to the term that you have to combine your finances and your personal life or your private life. Most 50 of the couples share a same account to help to pay the bills like the rent, light, and more. It's always important to try to make an agreement to be in the same page regarding your finances. Create a budget and not to have a dominant party is important to be in peace. A certified check is a personal check certified by an institution. Give a better sense of security. And then the money orders is like a cashier check, but made by a non-bank institution like the postal service. Traveler's checks are the most commonly used abroad. They don't have a name for the payee, and they come in different amounts: 20s, 50, or hundreds, and they are accepted everywhere. Electronic fund transfer, or EFTs, refers to any financial transaction that takes place electronically. It changes rapidly in cash management. The good thing about this is that transaction is pretty much instantly, like when we go to paying groceries or other things with our debit card, or when we select our direct deposit for the paycheck. Uh, Here we don't refers to the credit card because credit cards don't involve electronic transfer of money, rather borrowing of money. There are other type of cards. An ATM debit card is something between checking accounts and a credit card. It allows you to avoid carry cash. Uh, Card blocking refers to the term when a fixed amount is blocked by some of the service, like an hotel or rent a car. The best way to release that money that is blocked is by paying the service with the same card. Otherwise, it will can take like 1 or 2 weeks to return to release the money. Smart cards refers is what is commonly used nowadays. It's like when you have your debit card, credit card, or even IDs like driver licenses and college ID uh, in your phone. So it's easier, and you don't have even to carry a wallet to have your money with you, and it's way safer. The other type of cards is like prepaid debit card and gift cards, like telephone cards and, and merchandise cards. There are like two type of cards: uh, closed loops, closed loop cards, and open loop cards. Closed loop refers when you have a gift card that you can use only in one certain brand or one certain merchandise store. An open loop is a gift card that you can use in many different stores. Automated teller machine. An ATM provides cash instantly by inserting your debit card and pretty much putting your PIN. Remember that if you use your credit card, you will be borrowing money and not using your own money. And most of the times they have a impressive high rates. ATMs are more convenient. You find them in many places and they work pretty much 24/7. You insert your PIN and done. When you use a different bank ATMs, most of the time they charge you for a fee, so you have to take care about it. And the big problem with the ATMs nowadays is crime. The checklist to be safe when you use your ATM is secure your card, always have in a safe place, guard your PIN, never share with nobody, and don't use like your birthday or something like that. Check your receipt so you can always be sure that the money you receive is what it appears on the receipt. Look for your surroundings so nobody is watching you, and minimize time spending so you don't attract much attention. Some of tips, people tend not to think in the future, and that includes savings. They know that emergency can happen at any point in time, but most of the times we lower that type of emergency, so we don't have to save a lot of money, and we can spend more in the 2 days. And this is what is called the temporal myopia. The best thing is to save and be prepared for the worst case scenario in case something happened like the COVID-19. If you are bad saving money, here are some tips that can help you with your finances. First, create an emergency fund. Always try to ensure that you are prepared for the worst case scenario. Use a strong password and a secure network. Most of the times we are connected to many Wi-Fi networks, even like in Starbucks, and they are not secure, and your IDs can be stolen. So always try to keep an eye on that. Pay your bills online and set up an automatic payments. They will help you to avoid the payment of late fees and keep your finances on goodwill. And use online alerts so it can always tell you when you have a low balance and you don't run into overdraft fees. Thank you.